I'm going to show you a very simple trading strategy that literally just uses market structure and liquidity. No fancy indicators, no lagging BS, literal just market structure and liquidity. This strategy can be used with any asset, any time frame, day trading, swing trading, whatever. If you understand the fundamentals of this, it can be applied to however you want to do it when it comes to attacking the markets, and especially with prop firms. Now, just like I say before every other strategy video, guys, if you do not do the unsexy work, aka journaling, looking at all the trades you took every single session and seeing what you can learn from them, win or lose, green or red, pushing through the models, not strategy hopping when you have a red day or just a singular loss. Guys, if you don't do this important stuff, you will never get profitability. This strategy will still be useless because you're still going to be spinning your wheels and understanding that trading is more just on the charts. The stuff that you do off the charts is going to get the results that you want on the charts. So now without further ado, let's get onto the chart, get into the strategy, and see how exactly you can use this. Okay, so now we're here on the chart. I want to show you guys just real quick what is the context behind this, okay? Because I told you, we're just using market structure and liquidity. So how do we find both, and how do we add this into a very mechanical way of trading it? And we can do this every single day. Okay, so I'm going to show you right now. It's so simple. You guys are going to be like, dude, this is crazy. So you have higher highs and higher lows, okay? You have consolidation, meaning you have an equal highs and equal lows. Or you have bearish market structure, meaning you have lower lows, lower highs. Okay, this is market structure 101. Gurus are charging thousands of this per month just for you to understand this, all right? I'm doing this completely free, so if you have value in this, if you find value in this, hit that subscribe button, like this video, and I will do so many more videos like this in the future. So, step number one, finding market structure. So that's the step number one for the mechanical process of this strategy, is where are we on the higher time frame? In my case, I'm a day trader, so I'm only going to be trading the hourly time frame of finding the market structure, and then I'm going to be hopping down to the 1 minute to see where my entry is, right? So step number one, what is the high time frame structure? We can see right here with the current S&P 500, we are making higher highs and higher lows. We are objectively bullish. You can see here's that higher low. Step number two, liquidity. What is liquidity and what are we looking for on how to find it? Guys, if you are in a forest, okay, I tell people this all the time. If you were in a forest and you had a giant elephant-sized footprint and you just were like, huh, you wouldn't sit here and think, well, is there a fox nearby or some small animal? No, you would be like, there's a large animal, or if I knew what an elephant footprint looked like, that would be an elephant. There's an elephant in this area. You would know that because they left their footprint behind. So I like to call these liquidity footprints. When you just have huge wicks, impulsive wicks on the top and the bottom of candles. Okay, because what is this giant wick telling you? People will use indicators, people will try to find every which way to predict the market, to see where the market makers are moving. Guys, it is objectively simple that these people that move the markets, they leave these footprints behind, meaning they leave these giant wicks for us to see where the buy pressure and the sell pressure is coming from. So we know with a high probability, in this case, if you have a giant wick on the bottom, that when this candle was forming, buyers were able to snap this candle all the way back up to the close right here. And then vice versa, look at this. Sellers, when this hourly candle was forming, or whatever time frame you're on, sellers that are able to move the market with liquidity and volume were able to sell off price, creating this giant footprint for us to know when there's going to most likely be sell pressure. And now, boom, look at that. Creates this giant wick, so we know that we have a high probability if price comes back into this zone, there's going to be sell pressure, and if price comes back into this zone right here, there's most likely going to be buy pressure. Again, can this be voided? Yes, that's what causes breakouts when you have closures below or above a support or resistance. Yes, it's not about being right 100% of the time. Trading is about risk management and using high probability and high quality setups to manage your risk. Okay, it's not about being right. It's not about being 60, 70, 80% win rates. It's about risking less to make more and using those high quality decisions to use that risk management and use the business decision that you're going to take on the charts. So now that we understand market structure and we understand liquidity, let's use this into some examples here. I'm going to show you an exact trade that you could have taken. This was the 10th of January, so this is pretty recent. I'm recording this today, January 14th. So you can see here, question number one to the mechanical steps of this strategy. What is the market structure? You would just go to the 1 hour here if you were a day trader like myself, And you can see here, we are objectively making higher highs and higher lows. We can see that the market is turning bullish. We were bearish, making lower lows and lower highs. And the moment one of these highs that were responsible for making a low, the moment this was broken, you can see here, this high made a new low. Then we come up, we break this important high here. Okay, so when these highs and lows, when they get broken, like when we're in bearish market structure like this, if this high right here, that was responsible for making this new low, if this gets broken, then you know that there is objective buy pressure coming in. You know that now there is going to be a shift in market structure. Could this shift back? Absolutely, but you have a high probability. So in this case here, when you see that this high was broken by this low, you know that boom, this is now an important low that we need to take into consideration that's starting to turn into the bullish momentum. You can see then we lock in a lower high, right? And then we come back up and now we're starting to consolidate, because consolidation happens after a major trend of a bullish or a bearish trend. These consolidations are going to be either a correction or a continuation of the previous trend. So in this case, if the previous trend was bullish, we could expect we're either going to correct and break this support, or we're either going to continue and break this resistance and keep on going. So right now we're moving into this session. So again, number one is we are bullish. Number two, where is the liquidity? So you can see I already pulled this up for you guys. You can see right here, we have this huge wick on the top side telling us that there is objectively going to be pressure if we come back up here, and we have a giant wick right here, but I don't want to highlight this entire wick. Why do I not want to do that? Because we've already gotten a lot of this liquidity taken out. We just want to highlight the liquidity that hasn't been tapped into yet. So now we have this buy pressure here. We have another wick. You can see there was another wick right here that I highlighted because I just want to see closest to price. Okay, let me move this back one candle. I just want to see, because I'm just simulating like I would start at 8 o'clock in the morning. Again, you can do this however you want. You're going to backtest this and find this happening so much, you're going to literally subscribe to the YouTube channel right away. Like, it's going to be crazy. So you can see here, this would be the start of my day. This is how I would do my analysis every single day. Okay, so now we reacted up. We're just waiting for a reaction off this buy area. Now let's go to the 1 minute. So now in the 1 minute, if we know that there is an objective bullish presence in the market, I'm not going to subject myself to shorts. That's where we use the market structure off the 1 minute to get us into our entry along with 1 minute liquidity footprints. So you can see as soon as price, before our session starts, let's just zoom this up 1 minute. So we start our session. There we go. It's 8 o'clock now. So we can see, looking back, what have we been doing? So we've been making bearish market structure ever since we reacted with this sell pressure up here, this sell zone, this liquidity footprint on the bearish side. Once we did that, we started making lower lows and lower highs. How do we highlight this to see this so it's objective and not subjective? All you got to do is you start using this little rectangle box. You can start from the previous high that made a new low, draw it. You can have this little midline here because price likes to retrace 50% of the way. That's how it normally works. And then once a new low was formed, you find where that high was responsible for making that low. Then you trace it again. Same thing. You trace it again. It's very easy. And now this is the wick on the 1 hour that we're going to be paying attention to. So now all we're looking for, since we are answer to number one, bullish, answer to number two, we found the liquidity, is I'm just looking for either a reaction off this bullish liquidity or a shift in the market structure that we get in with a continuation of bullish market structure, or we break this support here by closing below here, and then I start looking for shorts, right? So the market is very free right now on all these different ideas that we can do. So now what we're going to do is we're just going to wait and see, do we have a reaction off of here? And we can go ahead and start drawing. So see, look, right here is a perfect example. This high that made this new low was broken. So now we're shifting into the bullish side. We're also shifting into the bullish side as we come closer to this buy zone that we drew on the 1 hour. So now things are starting to make a little bit more sense on getting our entry so that way we are not making a bad mistake of getting in too late or getting in too early. So now we just take this low, draw it up until we start seeing a retrace in price, aka creating a swing point. And you can see right here, this was that low that made that high. Then we just draw it out. You can see now this low was responsible for making this new high. So you just draw it out. And you can see we temporarily dipped back in here, breaking structure to the downside, and we're coming into this buy zone. So sometimes you don't want to be super crazy and super just analytical where you're like, oh, well, now we're shifting bearish, because you have to see where's the motivation for price to go to. These liquidity zones make motivation for price to come to it. So now again, yes, we're starting to shift bullish. You can see we're making higher highs and higher lows objectively, but I want to see us react off of this zone. So then this would just be the last thing. So right here, we come into the buy zone. As soon as I see a bullish shift start to happen here, you can see you have some bullish reactions off of this buy zone. Boom, right there. As soon as I get a nice good candle closing above all this little mess here, as soon as I have a bullish reaction off this buy zone, wait for the candle to close, click my buy. My stop loss will be right below this low here. And this is what I want you guys to understand when it comes to trading this is you have to understand that the risk that you use when it comes to your stop loss, you have to already just write off, okay, I'm happy losing, in this case, $229 for the reward of gaining 881. Like, this is a beautiful risk to reward. This is why you can lose 2 to 3 to 4 times in this trading model. And if you stick to the rules and stick to proper risk management and a daily loss limit for yourself and use risk to rewards like this, you're going to objectively be profitable. This is what gets retail traders. This is what gets people from being profitable, is they take a few losses and then they go and watch another stupid YouTube video on another strategy. They add a bunch of indicators to their charts. They're all over the place, right? You have to be okay with this. I don't even know if this is going to win or lose. I just picked a random day and we're going to start back testing it. So you can see here we reacted bullish. Okay, we're bullish on the higher time frame. So now I'm just waiting for price to now play out, and either I get stopped out or either we take a win. And as this trade is playing out, to help our psychology, because that is the most important thing here, and that's what I focus on, what matters, psychology, discipline, and consistency. So you can see here what's happening. We're making higher highs and higher lows. So this low is now responsible for making this high. You can see price retraces about 50% of the way. And now as soon as we break a new high, we want to mark this low right here. So this low was responsible for making this high. So now, let's say I missed this trade. Let's say I missed the liquidity trade. Well, now you just look for what's the next rule, right? Rule number 1, we found market structure. Rule number 2, we found our liquidity footprints on the higher time frame. Rule number 3 is if we don't get any of these buy or sell zone trades, which I deem as the A+ setups for these, we find liquidity footprints on the 1 minute chart, like the lower time frame entry chart. In this case, we can see here's liquidity here. Again, we just have these giant wicks. There is liquidity right here. And all I'm looking for is if we're bullish, I'm looking for a bearish candle to create a giant wick on the bottom, or if we're bearish, I'm looking for a bullish candle to make a giant wick on the top. Because if I know that there's buyers willing to overtake sellers here, then I'm most likely going to have a good chance. So if I didn't get into this trade, I would be looking for bullish reactions off of this liquidity footprint. So let's see if we get that. And you could even use this as a way to add to winning trades, so that way you're just letting your runners really run. So we're melting through it a little bit. We want to get that nice candle closure above these liquidity footprints. So let's see if we get that, or we could just come down and get stopped out. It's totally fine. So right there, we get stopped. Now we're just waiting for another reaction in a bullish side. Boom, right there. Bullish side, we close above that buy zone. So what we're going to see right now, you'd be down $250. Oh my gosh, I'm going to stick to another strategy. I'm going to go somewhere else. It's not working, whatever. We get a bullish reaction off of the buy zone from the higher time frame. TP, again, shooting for a high risk to reward, allowing these trades to play out. So now we're going to delete these because we have melted through that. And we're just going to see what happens again. Okay, so as you can see here, we got stopped out of this trade. So now we would just be letting these trades play out again. Okay, so now all I'm looking for is another bullish reaction off of this buy zone. Again, we took a loss here. I took a very small loss here. And now we're just letting the price action tell us when there is a good opportunity to either get into this trade or now start shifting bearish because we break that support. So there we go. So now look at this. We got a good candle close above the buy zone. We have higher highs and higher lows starting to want to form. click that buy, stop loss below this low point where I know if we get here and break this low that was responsible for making a new high, then I want to be out of the trade anyways. Shooting for another positive risk reward ratio that is just honestly the next point that I see. If we react off here, we're going to go to the next area of liquidity, right? And then as this trade is playing out, let's see, okay, right there, full take profit. So you would have taken 1, 2 losses, and then that full win. So you would have won only 1 out of 3 trades, but still come out on top because you stick to positive risk management and you just allow these trades to happen. So now let's say you miss this trade, because these trades happen so often. So you can see right here what happened. We shifted into bullish market structure once again after we broke down a little bit, digging into this buy zone a little bit more. So let's say you missed the buy zone trade. You were looking away. You were watching other YouTube strategies on how the best way to add indicators and predict the markets, whatever the heck you were looking, right? You break into bullish market structure. You see, okay, this high made a new high. So where was the low that made a new high? You can see it was right here. And then once we started retracing, which was right there, now all you're looking for is a continuation of the trade. So now if you know that we're starting to shift bullish again, you know that you reacted off of a buy zone, which is this zone right here, find your liquidity footprint for your entry. You have all of these giant wicks here. So any one of these wicks that were created in the beginning, as soon as you have a bearish reaction off of any of these wicks, right here would be your first one, boom. Stop loss right below this, because if you get stopped out, you get stopped out. You're trying to shoot for positive risk reward ratios, not getting a 99% win rate. So now this would be your trade where you would be targeting this. And again, this happens so often. So let me give you guys one more example, and then I want you guys to get off this video and go back test this for yourself. So let's go back to the hourly. Let's squish price action down so that way you don't think I'm cheating or cherry picking any of this stuff. Let's go to Monday, November 13th, right here. Let's pull up our chart. Again, question number 1. Where is market structure? What is the trend of the hourly time frame? Because I'm a day trader and I'm going to go down to the 1 minute. If you were swing trading this, right, you could do your entries on the 1 hour and use the 4 hour as your, higher time frame confluence, whatever it is. So in this case here, you could be like, well, I'm having trouble seeing market structure because I see we're bullish here, but then we break here. Again, just be objective. You have this high making a new low. Wait until this gets broken. This gets broken, but ever so slightly. So we want a good break. Here's a good break. This high, or this low made a new high, and then what happens? We have a break in market structure here. So now we're turning bearish. This high was responsible for making this low. And then what happens here? This high that was responsible for making a new low was broken here. And now this low has made a new high. So now we're bullish. That's all you got to do. And now you know objectively, not subjectively, of, well, we're looking bullish. Now you have a clear and cut way of seeing that. So now if you know that we're bullish on the higher time frame, find your liquidity footprints. Question number 2, you see here's huge wicks here, closest to price action. We're not sitting here finding liquidity all the way down here. I just want to see closest to price action, where is my liquidity footprints? We see another one here, and look what happened. As soon as this giant liquidity footprint was made, as soon as price came back and retraced, what happened? Boom, it made that higher low, and it locked in another higher low for bullish market structure. And then for the sell side, for sell pressure, here's my sell pressure using just the top of the wick to the base of the candle, showing there an area where we're most likely going to sell off if we get into. Go into the 1 minute time frame. Where are we at on the 1 minute time frame? We can see we are objectively bullish on the 1 minute time frame. We have already reacted off that buy zone again. So just to give us some kind of lay of the land, we can see this low was responsible for making a new high. This low was responsible for making a new high, and we're still in this high. So let's just wait for a pullback, so that way we know when we can take a trend continuation trade. We're actually 7:02, so let's go all the way to 8 o'clock. Let's just, for very simplistic purposes, I want to be very consistent with this. Let's act like we're at 8 o'clock every single morning. So you can see here's 8 o'clock, 7:59, boom, 8 o'clock. So we're still reacting off of this buy zone. We're now starting to break into a structure a little bit. You can see as soon as this low that was responsible for making this new high, we get broken right there. So we're shifting a little bit bearish, but we're still that higher time frame confluence in that buy zone is letting us know we're still probably going to be bullish until we break this support. So now we can see this low was responsible for breaking this temporary little break again. So this low made this new high. And now let's just wait, because now it's 8 o'clock. So now I'm either waiting for a liquidity footprint to be made, or if we come into this buy zone and react bullish, I'm taking that trade. So now let's see what happens. So right there, we have a liquidity footprint created from this bearish candle. I'm tracing it from the base of the candle all the way down to the bottom of the wick. I'm waiting, and then in this moment in time, I'd be waiting for a bullish reaction off of that, which we get right here. You can go ahead and then boom, I would go long, stop loss below this, because if we get tapped into it, I lose 83 bucks, and I use another good high risk to reward for making back the small little losses and getting the large gains. So now let's see, we get stopped out, we get another bullish reaction, get right back in. Does not matter about winning every single trade, it matters letting the winners win and letting the losers lose. Very, very subtly. We get another bullish reaction. So we now have lost 2 trades in a row. Who else is going to show you losing trades on a backtest strategy video? So there's another bullish reaction. We would go long, waiting. So we're 0 for 3 on this. We have a bullish reaction off of the buy zone again, taking another long, stop loss below that. And you would just let these trades play out. So here we go, we're making bullish market structure. We're now breaking out, and you can see if you were to allow these little small losses to get in your head and, oh my God, it doesn't work, you would not have the value now that this can provide if you just stick to the plan. So now, due to risk management, you can see here, we're already floating nice in profit. So there's 2 different ways you could have done this, right? Step number 1 is this would have been the long. Stop loss here. You could just be very quick about it, right? You could just target good positive 1.5 to 2 risk reward ratios, and you could have got this. Another example is you could just shoot for the next area of interest that price could most likely retrace to, which would be the sell liquidity, the sell zone up here that we made on the hourly time frame, and price could have motivation to come to it. So let's just act like we were being a little aggressive and just shooting for the next area, just like we did on that one. You would have gotten stopped out. So if you were shooting for a 2, you would have won it. If you were shooting for this, you would have got stopped out, and you just have to be okay with those happening. So now look at what happened. We have a breakout to the downside. So let's say you did get stopped out again. You're just waiting for another short. So this would be that short. Okay, stop loss below the high that made that low. You could target a 2. You could target the other side of liquidity. Let's just let the trade play out. So if you were at a 2 risk to reward, this would be your 2. And then let's just see if the other side of liquidity gets tapped. And right there. So this would have been the trade that you would have won all of your little losses back and then some. Or again, if you hit a 2, you would have hit a 2 right there. And then you would have hit a nice 3 risk to reward by just targeting the next area of context, meaning this area here, which would be your buy zone. And then again, now that we broke a major level of support, or if you still, and this is another thing that's going to get so many people just still demolished and wondering why they're not profitable. In this scenario right here, you would be up very nicely for the day, right? You would have taken maybe 1 win here if you were shooting for 2s or whatever, or if you were shooting for this, then you would have had 1, 2, 3, 4 losses, and then 1 major win that made back all of those small losses and then some because of good risk management. But you need to know when to quit. So in this scenario here, you would be done for the day. You would be done, profitable, boom, green day, moving on to the next day. So again, 1 more example, and then I'm going to end the video here, and I want you guys to go and backtest this for yourself. So we're going to fast forward into the next day. So 7 o'clock, are we still bullish or bearish? Question number 1. Question number 1, market structure is bullish. We have a low here, made this new high. This low came down here. We thought we were going to start turning bearish because this high never broke this high here. Then we come down here, we break this high, so we're still bullish. Okay, we are objectively still bullish. And now we're just allowing price to tell us when we need to get in and out of trades. So now we have these huge liquidity areas here. Why am I not highlighting this whole thing? Because I'm waiting for, I want only the areas that price never made a full body into. In this case, you can see we've tapped above this a bunch. This is a very crucial area of support. I'm finding my sell zone, aka the bearish footprint on the hourly. There you go, using the top of the wick, tracing it until I hit a candle body. So here is my buy and sell zones for the hourly. Now I'm going down to the 1 minute time frame. Okay, so now that we have our buy and sell zones for the day, we're now just going to drop to the 1 minute time frame where this is going to be our simulated session starting. Again, there's no magical session, magical time, whatever. So now we're just waiting for, okay, if we're bullish on the hourly time frame, I only want to expose myself to longs until price tells us otherwise, aka if we break this level of support, then we'll start looking for shorts, or I'm looking for price to react again off this bullish area because I'm being very disciplined on waiting for 8 o'clock, or I will take the continuation of this bullish trend if we get a pullback in this area, or I'm waiting for a breakout of this liquidity to continue taking bullish trades. So now let's see what happens. So what is the market structure on the 1 minute? We were correcting for a bit, coming down here to this bullish buy side liquidity, or the buy zone, whatever you want to call it. There's so many weird names. So you have a low here. This low was responsible for making this high. If I wanted to take the continuation of this trade, we can wait until there is a liquidity footprint from a bearish candle because we're looking for longs. We still do not get that. We have a little one right here. So we would want to see price retrace back into, but what happened? Now we have a new high. So now that this new high is made, we have to find where was the low that was responsible for making this new high. We need to wait for this pullback to happen for us to then see, okay, boom, pullback happens. This low made this high. We have a bearish candle here creating a bullish liquidity footprint from the wick. Now we want price to come into it, tap into it, and create a bullish candle, not the exact one that comes after. We want price to come back into this area just like that. We want a bullish reaction. We don't get it, price closes below it, so I'm going to close that one out because we closed below it. Let's see if we tap into this other one. We tapped into it, but it looks like there was news here. major news. Look at that. This was November 14th. Oh, baby. That was crazy news. But again, you'd be like, well, Austin, it's news. You don't want to trade anymore. Guys, this happens so often, it's not even funny. So now you're just taking more bullish trades. Okay, this giant distribution that just happened, we would still be looking for trades. So now you're just waiting for a bearish candle to create a bullish liquidity footprint. You see that right here. I want to see this low be broken so that way we can continue making bullish market structure. We just did. Now we need to see a pullback so we can make sure that this low is the responsible low. There you go. You can see now this low made a new high. We're coming back to that 50% area. I want to see us create a bullish reaction off of these wicks. I want to see a good candle close, not just a very subtle one. So there we go. We have a bullish candle close right there. Stop loss is protected right here. So if we get into this area, we don't want to get into it anyways, right? We don't want to be in the trade anyways. So let's see, do we get stopped out? We get stopped out. It is no big deal. We have another bullish liquidity footprint right there. Taking it again because we're still bullish objectively. Again, this will be a scenario where you could target. Here was your stop loss. If you just wanted to target the next high, so you just want to be quick, you don't want to be greedy, because again, you cannot let greed get in the way of your profitability. So in this case here, you would have already hit full take profit. We're just targeting that ever so subtle that next higher high, and you can see this one would have hit. So if we put our TP there, I already missed it because I'm on replay mode, but you get the point. So that one hit. So this would have been the trade that I would have taken, where if we're already super bullish like this and we're already like breaking above these sell zones, then all you got to do is again just be happy with these 1.8s, 1.5 risk to rewards, 2 risk to rewards. You don't have to always get these beautiful, sexy 8R, 10R trades. These right here can take care of you way more than 8R, 10R, 12R, 15R trades ever will. So then you'd be done for the day, right? This would be a beautiful, you lost one trade here, you won one beautiful trade here. Super good day. Super good day. But again, so many people, they don't know when to quit. They don't know when to take those profits and then wake up the next day and then do it all over again. So I hope you guys got value from this video. If you did, drop a like on the video. Comment down below any other way that you would like to see this be done, and maybe I could do a part 2 to it. But until next time, I love you guys. Thank you so much for watching. And as always, stay grinding on your goals and never let anyone tell you that you can't do something they have never done themselves. And I will see you guys later.